Welcome to the second video for Chapter 4. Retained earnings is an account where we accumulate all net income or losses the company has had since its inception that have not been distributed as dividends. To determine the ending balance for the period, we will start with the balance we had at the beginning of the period. Net income will increase retained earnings, net loss will decrease retained earnings, and dividends will decrease it always. If a company had a number of bad periods, the balance can become negative and it will be called accumulated deficit. A corporation will declare dividends to keep their shareholders happy. After all, one of the major reasons investors would invest is to share in the company's profits and have a return on their investment. Corporations face a lot of challenges and pressures from analysts, competitors, and their past performance. Their dividend policy is scrutinized for consistency, how many uninterrupted years dividends were paid, dividend amount with a preferably an increasing trend, so sometimes a company will pay dividends just to maintain their good record. There are many types of dividends, but the major ones are cash and stock dividends. Cash dividend requires the company to have a sufficient amount of cash on hand, which sometimes could be a problem. Stock dividends do not require the company to part with cash, but still report dividends. Stock dividends come out of retained earnings, so they would decrease the account just like cash dividends would, and they would increase capital stock. The accounting side of this transaction will affect only the equity section of the balance sheet. Splits are not dividends, but affect the number of shares and the par value of the stock. In case of a 2-for-1 split, the number of shares will double and the par value will decrease in half. When the company goes on the market and repurchases its own stock, it's called treasury stock. Treasury stock is a stockholder's equity account but reduces total stockholder's equity. Treasury stock does not vote, receive dividends, or have other rights. When a company has treasury stock, the number of shares that are available on the market are affected. These shares are called outstanding shares. Out of all issued shares, since treasury stock does not receive dividends, only the outstanding shares will receive dividends. The outstanding number of shares becomes important when calculating dividends per share. There are a number of reasons why a company will repurchase their own stock. For example, earnings per share ratio will improve. As the outstanding shares go down, the net income is divvied up to less number of shares. Other reasons are to provide stock compensation for employee retention plans, to prevent takeover, or manipulate the market price by changing the supply and demand. Other comprehensive income or loss are revenues, gains, expenses, and losses that are excluded from the income statement. Examples include unrealized gains or losses on securities, foreign currency transactions, and gains or losses on pension plans. Other comprehensive income can be reported either on the balance sheet in its equity section, at the bottom of the income statement, or on its own separate page. Accumulated other comprehensive income is used to accumulate unrealized gains and unrealized losses within the other comprehensive income.